Explain the monetary policy transmission mechanism simply. Have you ever wondered how decisions made by a central bank can ripple through the economy? Let's break down the monetary policy transmission mechanism in a simple way. This process shows how actions like changing interest rates or adjusting the money supply can impact everything from jobs to prices. It all starts when a central bank like the Federal Reserve in the United States decides to change a key policy rate, often the short-term interest rate. This change does not just affect that one rate, it influences other interest rates across the economy. For example, when the central bank lowers rates, loans, mortgages, and savings rates also drop. This makes borrowing cheaper for both businesses and consumers, encouraging them to spend more. When people and companies borrow more, it boosts overall demand and economic activity. On the flip side, if the central bank raises rates, borrowing costs increase, which usually leads to less spending and a slowdown in the economy. There are several main channels through which these effects spread. The first is the interest rate channel. When the central bank lowers its policy rate, market interest rates follow suit. This reduction makes borrowing less expensive, which encourages investment and spending. Conversely, higher rates discourage borrowing and spending. Next is the credit channel. Changes in monetary policy can affect how easily banks lend money. If the central bank adopts an easier policy, banks may be more willing to lend. This increased credit availability supports spending and investment by households and businesses. Another important channel is the asset price channel. When interest rates change, it can impact the prices of assets like stocks and real estate. Higher asset prices can make people feel wealthier, which often leads to increased spending and investment. The exchange rate channel is also significant. When interest rates change, it can affect the value of a country's currency. A lower interest rate may weaken the currency, making exports cheaper and imports more expensive. This can boost domestic production and inflation. Lastly, we have the expectations channel. Monetary policy can shape how people view future inflation and economic conditions. If individuals expect stable prices and growth, they are more likely to spend and invest. The transmission mechanism does not work perfectly. There are frictions in the economy, such as price and wage rigidities, which can delay adjustments. This allows monetary policy to influence real economic activity in the short term. In practice, central banks use tools like open market operations, where they buy or sell government bonds. This action changes the monetary base and influences short-term interest rates and the money supply. These changes then ripple through the channels we discussed, affecting overall demand, inflation, and employment over time. In summary, the monetary policy transmission mechanism connects central bank decisions to real economic outcomes. By affecting borrowing costs, credit availability, asset values, exchange rates, and expectations, it shapes spending, investment, and prices in the economy.